Inflation is often described as rising prices, but that's not the real cause. Prices don't rise on their own. Something pushes them higher. And in most modern economies, that something is the expansion of money and credit. For thousands of years, money was tied to physical assets like gold or silver. The amount of money in the economy could only grow slowly. But modern financial systems work very differently. Today, most money is created through lending. When banks issue loans, mortgages, business loans, credit cards, they create new money digitally. That money enters the economy and increases the total money supply. Now imagine this happening across the entire banking system. Millions of loans being issued every year, each one introducing new money into circulation. When the supply of money increases faster than the supply of goods and services, prices tend to rise. This is one of the main drivers of inflation. Let's think about a simple example. If there are 10 houses in a small town and buyers collectively have £1 million to spend, house prices will reflect that amount of money. But if banks suddenly create another £1 million through new mortgages, buyers now have twice as much purchasing power. More money is now competing for the same houses. Prices rise. This dynamic doesn't just affect housing. It affects food, energy, cars, rent, almost everything in the economy. As the money supply expands over time, the purchasing power of money slowly declines. Central banks attempt to manage inflation primarily through interest rates. Higher interest rates make borrowing more expensive. This slows down lending and reduces the speed at which new money enters the economy. Lower interest rates do the opposite. They encourage borrowing and increase the flow of credit. But here's the challenge. Modern economies rely heavily on credit. Mortgages, corporate debt, government borrowing, and consumer loans all play a major role in economic activity. If lending slows dramatically, economic growth can stall. That's why central banks often try to balance two competing forces, keeping inflation under control while also keeping the economy growing. Understanding how money is created helps explain why inflation tends to appear again and again throughout history. It's not simply about companies raising prices. It's about how money and credit flow through the financial system. And once you understand that connection, the behavior of the economy begins to make much more sense.